So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and today I'm joined by Steeve Breton. Steve is the founder of Velocity Capital, a private equity real estate investment firm. He's a sponsor in over 2,000 apartment units, valued at over $200 million. He's also invested passively in over 20 syndications. Prior to founding Velocity Capital, Steve built a successful career in IT systems, responsible for large teams and multi-million-dollar projects. Steve holds an MBA from Babson College's Olin School of Business. Steve, welcome to the show.
Hey, Jonathan, thanks for having me on the show.
Absolutely. So we were kind of having a nice conversation offline, which is always nice to kind of set it up. So we'll just start at the beginning and kind of talk about, what led you to this industry. And then ultimately, we'll kind of get into your early retirement and financial freedom.
Cool. Yeah. So the nickel tour was, went to college, wanted to get a good job and follow the typical path. End up doing 25 years in IT and finance, managing the business of IT. Along the way, I started to invest in real estate in, it was like 2012, 2013, buying properties here locally in Boston. That's because, during the great financial crisis, 2008 through like 12 timeframe, my stock portfolio just got slammed and my 401k was down. I was like, I have to do something different. And that's why I started buying the smaller properties. And I was self-managing. And at some point I started thinking, well, if I bought enough of these things, I could just leave my job and be a landlord. And if I calculated, I needed something like 50 units. So when I got to, I think it was 16 units at the time, prices were getting more and more here. So, not everything worked so well in terms of cash flow. And I also was, I had an hour commute. I was coaching my kids' soccer teams and I was like, I can't get up to 50 units. Like this isn't going to work. So I started to invest passively. Somebody just introduced me to a syndicator, which I had never heard of at the time. Of course, nowadays it's much more popular and you hear about it all the time. So I made that, that first $50,000 investment with a syndicator. It scared the heck out of me. It was hard to let go because I was used to managing everything myself. But I did that. It worked out really well. 2-year hold. I did a couple of others just after that when I started to see the cash flow coming in. And then, they started to sell off. And I'm like, wow, like I'm making a lot of money just on 100% passive investment. This really works. And I started talking to the syndicators about how they did it and, their fees and all that sort of thing. And they were nice enough to show me a bit about the business. And then I went and got myself trained and started hitting the conferences and launched the business in 2017 as a syndication sponsor. And ended up leaving my job in 2019 after doing the side hustle for a couple of years. And in between there, just before starting that business, I was focused on like extreme frugality, trying not to spend too much. That way I could retire at some point. I didn't even know if I could ever retire comfortably, but I was just trying to improve that situation. But I was driving my family crazy, yelling at them about leaving the lights on and reducing our family vacations down to like camping or whatever I could do to save a few bucks. When I got into syndication, it was completely different mindset. It was all about how do I make a lot more money for me, for my friends, for my family. It was all more of the abundance mindset, which is way better than the sort of the scrimping and frugality mindset. So been very happy since then.
Awesome. I love that. That's a great story. And that's love right there when your family is willing to accept. And listen, I grew up camping, so don't get me wrong. I love camping, backpacking, still do it to this day, but something to be said about getting on an airplane and going to the beach as well. So
exactly right. You have to be doing it for the right reason.
Absolutely. Awesome. So Kind of talk about, you kind of gave us the Reader's Digest version of that journey. Talk about, this concept of early retirement, so to speak, what that looks like. It looks like something different for everyone, right? So kind of talk about what that looks like for you, and what you're educating your investors on, and helping them get there as well.
Yeah, a lot of the discussions I have in that space is really around, what do you want to do with your life in general, right? Of course, we all want some financial freedom. I always tell people, like, you have to think about your time freedom. Do you want to be working for somebody else? It's basically you're renting out your hours, right? You only have so many hours in your life. You're renting them out until you're 63 or 65 or whatever it is, until you can retire. Is that really what you want? And that helps people to just kind of get their arms around, or their mind around what it is to work for so long, or to end up retiring, or early retirement. And then it's, a lot of the discussion also falls back to, what are you going to do once you retire? Are you just going to sit around and rot, right? Like the boomers, or I think it's much more popular with people that are starting to retire now, or people that are looking to retire 5 or 10 years, to think about, what's my retirement going to look like? What am I going to be doing? How do I add value? What sort of volunteer work should I be doing? I'm very fortunate that the reason, or the way that I got out of my W-2 job was real estate, and I absolutely love doing it. And I love having conversations like these, where we're talking about, early retirement, or retiring into something rather than from something. So that's what I've done. I've retired into work that I love, and the ability to help friends and family to better invest, and hopefully to become financially and time free as well. When you said, what does it look like? The first thing that came to mind actually was, I want to do a lot of cool things, like mountain biking in the middle of the day, or going on a safari with a bunch of friends, or going, fishing in Alaska. And all of my friends are like, well, I can't do that. I'm working, right? No matter what I ask them, it's always, I'm working. And I'm like, damn, we need to help you get retired early so that we can go do something else.
Gosh, it's so true, right? And you nailed it on the head. Your definition is, you're still working, right? Like, you still have, obviously you have investors who rely on you. It's hard to say they're your boss, but investors are kind of our boss, so to speak. But so you still have a job, and you're still doing it, but you love it so much, and it's created your freedom, that to you, that's an early retirement. For some people, it might be literally just covering their expenses with passive income, so they can do whatever they want.
Mm-hmm.
So there really is a different definition for everyone, which is what I love. So once you kind of figure out what they want, are you, guiding them necessarily? Maybe that's not to invest with you. What does that conversation kind of look like?
Yeah, that's, it's a little difficult, because we don't want to be, financial advisors, right? Not licensed for that. And so,
right.
Obviously I'm super biased when it comes to real estate.
Right.
And that's how I start all the conversations. I'm like, look, I'm going to tell you things that sound crazy biased, because they are, right? Because I love real estate. It's what got me to the point where I could be financially free. So you have to take all of that with a grain of salt, and just consider, your options and what works for you. But I will tell you what it looks like to invest in real estate. And based on my history as a passive investor, because I did, as you said in the intro, I made like 20 passive investments before I ever started doing this as a sponsor. The worst one was like a 13% return, and the sponsor, everything went sideways on that deal. Sponsor felt horrible, and I'm still making a double-digit return. I'm like, okay, I can definitely live with that. But on average, it was more, 18, 20% returns on all of them. And nowadays, with the crazy market, it's even higher. So, again, I'm explaining this to people, and they're like, sounds too good to be true. And I'm like, yeah, it does. And the saying about, when something sounds too good to be true, but, that's my experience. It's worked out really well. So it's the same conversation I have with people with Bitcoin, or crypto in general, right? It's crazy. Like, you can make a lot of money, but you shouldn't put your entire, earnings in there, or your wealth. Just dabble, put a little bit in, and see what happens. And as soon as you have a little bit of skin in the game, you're going to research a lot more. You're going to keep, an eye on that market, in that space, and end up becoming more educated and making better decisions. And if you want to, go and put, 10% of your wealth in it, great, but make sure you understand what you're doing first. But to put in some tiny percentage, 2% of your savings in something, properly vetted, but you don't have to be an expert at it. I think that's perfectly fine.
Absolutely. And kind of speaking along skin in the game as well. Again, also not a financial advisor, but personally, subjectively, if you're talking to someone who's pitching an investment to you, we'll just take real estate, for example, when I talk to investors, I'm also investing right alongside you, my own personal money as well. Right. And so that's a huge factor because yes, it does sound too good to be true, but listen, I also have skin in this game too. So it's not just me asking you for money and hopefully it works out. We're going to do everything we can because A, this is how I make a living, and B, I'm investing right alongside you. So that's a big factor as well. When you're talking to people, and that sort of helps kind of alleviate some of that, especially for first-time investors. But let's kind of talk about now, get into the weeds on some of your deals. We were talking offline. Your favorite deal in Arizona, I'll allude to it there, but kind of talk about that, and then we'll get into kind of some debt stuff.
Yeah. So we've done 14 deals. We've exited 4. We're exiting. I just had another conversation this morning. So it sounds like we're exiting 3 this year. All of them have done well, but this one in Arizona was a home run. Partly because the Fed's printing money and things are going crazy, but also 3 years ago when we invested in Arizona, we knew that rents were growing north of 10% per year. We modeled the deal as a 3% rent growth because we can't count on it growing forever at that rate. We modeled the exit cap rate. I think it was a full point higher than the current cap rate 3 years ago. And just for those who might not understand that, all that does is it reduces your sale price, right? So it's putting pressure on your sale price so that if the deal still works at a modeled cap rate that's 1% higher, then you've got a pretty decent deal. And if interest rates were to go up during your hold period, it probably will reduce your sale price. So we want to be able to cover that, potential effect of interest rates. But in reality, interest rates moved down, cap rates compressed a ton, and rents ended up growing like 20% over the last 2 years. So, again, we call it the Fed-induced home run. Sure, we did a great job. We did everything we were supposed to do. We probably would have ended up with a 20% return anyway, but instead we ended up with like 50% annualized return. It was just silliness. So we couldn't refuse that offer. We took it. But at the same time, we had planned on a longer hold period, and we had a 7-year loan. And so selling it in 3 years, the bank basically said you have a prepayment penalty of $2.5 million, which was a shock to me. Like, that's so much money to leave on the table. But even with that, right, that's, the return I mentioned to investors, that was after the 2.5 million. So we gave up 2.5 because of the debt decision we had made when we got into the deal, and still had a great deal. So it just shows you how crazy the market is. But it's also a lesson learned for us about being a bit more careful of the debt that we're structuring.
Absolutely. Yeah. Is this in Phoenix or what?
It was in Phoenix. Yeah.
Okay. Yeah, that makes total sense. And, obviously, like you mentioned, 3 years ago, it was still growing, but the last like 18 months, have been crazy. The deals that are happening there, asset prices are, I think 250 a door is like a good deal. It's like a steal now in Phoenix.
Yeah, it's between our favorite markets are Atlanta, Tampa, Orlando, San Antonio. All of those markets are on fire, right? But that's why we invest there as well. That's why we invest in the South, in this the Sunshine States or the Sun Belt, because the market growth is crazy. People are moving there. The more people that move there, the less housing there is available, and the rents just keep going up.
Absolutely. So let's kind of go back. You mentioned you learned a valuable lesson in debt structuring. Kind of talk about your logic behind the 7-year loan and why you thought it was going to be more of a long-term play. And then, what lesson you learned and what that looks like now.
Yeah. So going into that deal, I had a couple of partners that hadn't exited a deal yet. They were newer at this. Maybe they were into it for a couple of years. I had already exited a couple of deals early. I had a small prepay penalty on one of those. And so I was already kind of thinking, okay, well, what if we only hold this for 2 or 3 years? If Arizona or Phoenix does what we think it's going to do, we may want to sell it in 3 years. And they insisted, no, this is a 5-year hold, maybe even longer, maybe a 7-year hold. So they insisted on getting 10-year debt, and the interest rate's a little bit lower on 10-year debt. So, it looked a little nicer, and we got an extra couple of years of interest only in those first few years, rather than 2. I think we got 4. So, the longer your debt period, the better the terms end up being, but you end up having to pay this prepay at the end. So, yeah, they insisted on the 10-year loan. I went along with it. I'm pretty easy to work with. And I'm like, it's still going to be great even if we held on to it for 5, 6, 7 years, it'd be fine. There's no prepay after 5 years on that. So we would have been, totally great holding on to it. But when we got this offer, it was way good, too good to refuse in the 3-year window. We just took it and we ate the prepay.
Makes total sense. And so now what does your structuring typically look like, or what's your ideal structuring look like?
So things are getting a bit more sophisticated on our structure. We have access to better terms with various debt and some preferred equity as well. On the term side, we're trying to keep them down to 5 years, because it's just, it's a pretty good chance we're not going to hold it for anything longer than that. And then the prepay on those would be stepped down. So it's, after like 3 years is really not much to speak of. So that's on the term side of things. We're also looking at using preferred equity on occasion, depending on the deal. Most of our deals that we get into are, they have a huge value add component. So we're able to add, millions of dollars. So for example, this is a fun one too, and I don't have the math fresh in my head. So let me see if I can do this. It's a deal, it's 340 units in San Antonio, and we can raise rents $250 per unit. And that's without any renovation, right? Just simply, it's under market because San Antonio has been growing so much. So you multiply 250 times 340 units times 12 months. That's the NOI that we'll have, additional NOI, net operating income. We could probably do that in the next 18 months, but call it 3 years out. So if we sell in 3 years out, that we've basically added, and the cap rate there is like 4%. Actually, the report just came out today, CBRE, it's down to almost 3%, but we're modeling it at a 4 exit, 4 cap exit. And at that price, it's $25 million in value added just by raising the rents to market value. And we're modeling that out to say in 3 years, it'll be at market level, at today's market level. But in 3 years from now, the rents are going to be much higher. So, I mean, it's ridiculous value add, right? So those are the sort of deals we're looking at. So if you're doing that with a little bit of pref equity, and a pref equity is basically, it's sort of like getting a second loan. So it feels like you're levering up a little bit more, but we'll maybe go, 70% loan to value, and then do, or 75%, and do another 10% preferred equity. But we know that we can refi in a couple of years. And so we refi that preferred equity out. And now all the equity that we've added in that property, the property value of 25 million, that gets shared with our investors, our true investors, not the preferred equity folks. And of course, with the general partners.
Awesome. I love that. That's a really great explanation. So kind of, let's talk about preferred equity. We were talking about a little offline. You mentioned it a bit there. Kind of give, kind of an explanation of what it actually is, and what, what it looks like in the debt stack, and then, when to use it, and when it could possibly hurt you.
Yeah. So as far as what it looks like. So again, we call it rented equity. So on this deal in San Antonio, it's a call it $70 million purchase price, round numbers. Figure we're going to come in with, call it 15 million in equity from friends and family, and then 10 million in preferred equity. So that's 25 right there. So you're basically coming in at, let's call it 75 loan to value. Bank covers the rest of it. I'm not sure those numbers work out exactly, but the point being, it's only 10% preferred equity. It's enough to really juice the returns. Or I'm sorry, 10 million in preferred equity, but we have that 25 million of value that we're adding. So, we've got, even if we only cash out refi half of that, we're still more than enough covering that preferred equity to get them out of the deal. They want to be out in 3 years. And they have all kinds of clauses in that contract where if they're not out in 3 years, they can start being very painful with you. Like there's escalation, you might be paying higher interest. If things go sideways with the deal, they can come in and try to take control of the deal away from the manager, where they would actually be managing the property. So they're basically stepping in front of you. So there are issues. It's a bit risky to do this on a deal where it's a thin deal. And some people are tempted to bring in preferred equity on a thin deal just because it's going to make the returns look better. Highly recommend against that. You want to make sure with 100% certainty that you can take them out well within that 3-year window, that the deal is fat enough where even if things go sideways, there's plenty of juice in it that they're not going to be feeling like they're getting squeezed or that they need to start triggering some of the clauses in the contract.
Okay. Yeah, that's a really great explanation. It makes perfect sense. And again, they, to kind of mention, they sit in that kind of second position, not obviously on title or anything, but their money is paid first, essentially.
Correct. Yeah.
Okay. Yep. And so, again, huge benefit to kind of, as you mentioned, kind of that rented equity. And as long as you're getting them out, obviously, especially under 3 years, you mentioned off camera that your ideal is getting them out within a year. Is that usually your guys' strategy there?
Yeah. So, again, we modeled the refi in year 3, just to give us plenty of time. We also modeled that we would get the rents up to today's market rents in 3 years. But in reality, since we've been on the contract for just the past 3 months, they're already getting those rents. So, call it 1/4 in the past 3 months, because they're all going to renew over the next year. So 1/4 of it's already done. There's a pretty good chance by, this time next year, we're already looking to refi.
And so are you, when these lease ups are happening, are you jumping right to market, or are you slowly raising these like incrementally?
So it depends, on this particular property, we're jumping straight to the market rents because it's a brand new property. Most of the tenants that are in there right now came in. They've only been there for a year. This property was just built. They started leasing it up a year ago, or a year ago, last December. So, they're on their first round. So all these tenants are in there with the idea that they were getting a $250, $300 discount on rent because they were trying to lease up 340 units all at once. Right. So they knew exactly what they were getting into, a brand new property with a beautiful pool. It feels like you're at a resort.
Wow.
So they're getting this, amazing property at a huge discount. They knew that when the renewal came, they were going to be paying full price. So it's
and so
not
did you
really
buy it from the developer and the builder? Is that why they were ready to get it off their hands?
Correct. Yeah. Yeah. The builders, again, they have a huge challenge of trying to lease up that many units. So as soon as they hit 90% occupied, they want to sell. They usually have equity partners as well. And it's usually like a big equity firm who wants their money out. So they're like, get it to 90% occupied as quickly as possible. And if that means you have to give away, $300 per unit discounts, do it.
Wow. And then that's obviously your guys' gain to then take over. And like you
Exactly.
mentioned, that's nice. So that's one of those sweet deals. Just want to mention those don't happen all the time. So.
No. There are, home runs on occasion. I remember hearing about home runs when I first started, and I'm like, that's not going to happen. Yeah. But I guess when you're in the game long enough, you can make some of those things happen.
And how are you connected to that market? Do you guys have boots on the ground there? Just, relationships you've kind of evolved throughout the years?
So I've done 3 deals in San Antonio. Sold all of them off, actually. One of them was in Tyler, Texas, but 2 in San Antonio. And yeah, we sold all of those off in the past year or two. So we know the market a fair amount. One of my partners lives in Texas as well. So, he's got, he's an hour drive over to San Antonio. So pretty easy for us to keep an eye on things. And he's a developer, so he knows people in that market as well as the other developers. So that helps us land deals like this one.
Wow, that's awesome. And this industry is all about relationships, all about who you know, and leveraging those relationships, and of course, helping people along the way. So kind of on that, we'll kind of come all the way back. One thing you want to talk about is kind of managing people's hard-earned money and what it looks like, setting the expectations for investors and kind of setting this all up. So kind of talk about, your approach to that.
Yeah, so I literally just was in Denver a couple of weeks ago doing a talk on raising capital at a conference there. And I think I had 3 points. And the number one point was, it's not about you, it's about them. And just the idea that, you've probably heard OPM, other people's money. And I'm like, and I asked the question, have you heard of OPM? Everyone puts their hands up. Of course they have. And they all want to leverage other people's money. And I'm like, erase that vernacular from your brain forever. Don't ever say it. Don't even think it. It has to be treated like it's your money. And it has to be, it's your mom's money. It's your neighbor's money, people that you really care about. And they worked really hard for that. My parents were immigrants, first-gen immigrants. They literally came here with absolutely nothing. Every penny that they have was hard work and, blood, sweat, and tears. And so just imagine that every one of your investors has worked that hard and, treat the money accordingly. And like you said earlier, if you have skin in the game, and if you don't, you shouldn't bifurcate your list, right? So if you're sending out a deal to your investors, it should be, is it good enough for my mom or my parents or, my best friends, whatever? And if so, it goes out to everybody. If not, it goes out to nobody. You shouldn't be doing that deal if you're not proud of it. And if you're not certain it's going to be good. So that's kind of the mindset that I approach it from right from the outset. The other piece is there's so many people who've never invested in real estate, but they have a 401k account, and they might have a brokerage account that's not retirement dollars at Fidelity or something. So you have to be giving them updates on what's going on, a portal where they can go in and see their account, just act very professional so that they can have a sense that you're at least as professional as who they're used to. And sure, it's a totally different space, and those updates are going to be once a month about the property upgrades that you might be doing, value add stuff, replacing landscaping, upgrading units, etc. As well as the finances of that property. Where are we on rent increases? Are they what we said they were going to be? If so, wonderful. If not, why not? And just explain everything, whether it's good news or bad news. Just let everyone know exactly what's going on a monthly basis. That's not something you're going to get from your Fidelity brokerage account about like every company that you're in, how they're performing, right? You can go find that stuff publicly, but nobody does. But we're sending out an email with that information on a monthly basis to make sure that people, get a good sense of what's going on. That generally keeps people pretty happy. I think, on occasion you're getting questions, you're generating more work for yourself by sending those, especially if you say, oh, we had a small fire, and here's what happened, right? You have to be very clear about, here's exactly what caused the fire. Here's how we mitigated it. Here's, how it's actually good for the property. Set aside the torture the tenants have to go through with being, placed into different housing or whatever. But after that, the insurance company is paying for upgraded units, and they're paying for lost rents along the way. So you're totally covered, and we're actually going to have higher cash flow once the units are rebuilt. But if you don't explain all of that up front, and that can be true of any kind of water damage or anything that happened, then you're going to have a lot of questions, and you're going to feel like you wished you hadn't sent out the email. But that's not, that's not the right way to go. You have to share it all, good or bad.
Absolutely. And that full transparency is so important because, again, like you mentioned, they're used to being able to just log into Fidelity or whatever it is and just, or maybe they have the app, not literally all they do is pull up the app, it checks their face and boom, they can see their account, move up and down with the market as it moves up and down. And so they're used to that, easy kind of just check on it, look how the market's doing and, get an idea. And so you have to kind of guide that along as well and have that same, again, it's not as liquid and it doesn't ebb and flow as much as the stock market, but,
That's a good
kind of
thing.
giving those updates is so crucial to not only first timers, but to keeping people coming back as well.
Mhm.
When they know that you're going to, if something does go sideways, that you're going to tell them how it happened, why it happened, and what you're doing to fix it. Listen, we all know that not everything goes up all the time, right? You're not always going to win all the time.
Right.
But if you're explaining the losses and what you're going to do, that's a repeat customer right there.
Exactly. Yeah. And in terms of the ebbs and flows, the great thing is, people might contact me and say, what do you feel about Ukraine? Or what do you feel about, rates going up or this or that? And I'm like, tenants are still paying the rent. Our net operating income is still X. The property is still worth, $50 million. The value of your shares are still what you put into it. You're getting cash flow every month. And, we continue to increase the value of the property. So you're in great shape. Like, it doesn't matter what's going out there. You can ignore all that noise. And we'll just keep, doing a great job at the property.
God, I love that. So sweet. That's why I love this industry so much. And I'm sure it sounds like you've probably dealt then with a lot of like first timers and kind of guiding them into this space.
Yeah. Quite literally it was, friends and family were the first investors because, I didn't have a lot of experience in this space. They knew that I managed my own properties. But as an investment advisor, unofficially, talking to them about real estate and how to place their money in it and, actually managing that money with a fiduciary responsibility, having the oversight from the SEC, all of those things are things that I hadn't done before in that first deal. So, they were trusting me as a person more than my ability in real estate. I did partner with somebody who had more experience, which helped. But yeah, I had to kind of walk them through all the steps, exactly what this looks like, get them comfortable with real estate. They wanted to, not that I had to sell them on it. They were interested and we kind of walked through it. So they invested and then they told their friends, and it's like, 70% of my investors are from referrals at this point. But most of those referrals are people that have never done real estate before. So it's the same conversation over and over, which I love having because it really, turns on a lot of light bulbs for people that they can have something that's a bit more steady, that's not correlated to all the crazy stock market stuff. And again, I'm not saying move all your money into real estate, but a little diversification is good.
Absolutely. And then on top of that, you sprinkle in, some of the tax incentives and things like bonus depreciation and things like that. And the next thing it just gets that much sweeter. So
that's a good
really
one.
awesome.
I never spent enough time, and certainly not in the last few years, more so recently, talking about depreciation expense. So if we just go back to that sweet deal in Arizona, right? So picture putting in 100K in a deal, and when the deal sells in that year that it sold, so you've got some cash flow along the way, but in the year that it sold, you're getting, I don't want to exaggerate it, so I'm going to keep it a little bit lower and say you're getting 75K. You get all your money back and 75K, right? Pretty nice gain. Now you're going to have to pay capital gains tax on that. Unless you take that money and you just simply invest it into another syndication. And it's not a 1031 exchange. There's no crazy stuff involved. You simply find another deal anytime in that same calendar year, place the money again, and the depreciation expense from that new deal on 100K placed is probably going to be close to your gain that you got in the last property. Of course, if you put in all 175, you're going to have more than enough depreciation. Your CPA is going to get from you at the end of the year a K1, one from the property that sold, which is a big gain, and one from the property that you just bought, and that's going to be a loss. And they're just going to net it out. It's called Schedule E netting. and you literally pay zero tax, which again, sounds way too good to be true, but that's how the IRS tax codes are written. They want to give an incentive for us to invest in real estate to provide housing for people. And because of that, you're not paying taxes on gains like that. And it's a huge gain to not pay taxes on.
Absolutely. And that's such a huge, I shifted when I talked to Jonah Weiss, who's like, the cost set king. He really shifted my mindset in understanding that these are incentives that are in place so that we're providing housing for people, right? There's a housing shortage right now. And by taking over these properties and renovating them, adding value, creating a better living space for people to live in, that's why these incentives are available.
Yeah.
It's not a loophole. It's not tricking the IRS. These are very clear, set forth incentives that are there for us to take advantage of.
Right. Yeah, that's it's a Tom Wheelwright always says the tax code isn't a list of things that you can't do. It's literally telling you what you can do. They're telling you what they want you to do. And one of those things is investing in real estate.
Absolutely. The IRS made it super simple. There's like, here's 4 things you can't invest in, other than you can't depreciate. Other than that, all of these things can be depreciated. And it's like, okay, perfect. Real estate's on that list. So
let's do that.
Yeah, awesome. Well, I've enjoyed the conversation very much. We are nearing the end. I do have 5 questions that I ask all of my guests. It's the final 5 questions. So we'll jump into those. First one is the best advice you've gotten from a mentor.
First thing that jumps to mind is only do fat deals, meaning deals that are super profitable. Like, don't even bother doing something that's only okay. There are plenty of fat deals out there. It doesn't seem like it when you first start, but they definitely come along.
Absolutely. Love that. What is it about your career that makes you feel like you're fulfilling your why?
That's a good question. The why is something I work on all the time, trying to figure out, we're going to be empty nesters here in the fall. My 3 boys are all kind of off. So it's, something we want to have a better, bigger why, but being able to help people retire early or have a better retirement, that's one of them. And then we're also doing a lot of work, volunteer work. So we mentioned time freedom earlier. I'm working 20, 25 hours a week, and then that allows me to invest a lot more time in our local community with different charities.
I love that. That's so awesome. Giving back is so incredible. What's your favorite non-real estate or investment related book?
I mean, I have to go back to Rich Dad, Poor Dad, only because it completely shifted my mindset, and probably everyone you ever ask that question to wants to say that. There was one other, Stephen Pressfield has a book called Turning Pro. It's very small. It's super quick read, but it's all about, like, if you're doing something, are you dabbling or are you actually acting like a pro? And if you're going to act like a pro, it's like your mindset completely changes. You do things that you wouldn't otherwise do. So if you're actually trying to move in a direction, you have to ask that question: are you dabbling or are you going to be a pro at it?
I love that. That's awesome. If you could have any superpower, what would it be?
Man, the ability to see the future. Yeah. I can't
course.
imagine the number of deals I would have bought a few years back, knowing what the economy would look like right now.
Gosh, if only we can invest in hindsight, right? It'd be
Yeah.
the best. Awesome. And last one, what's the best way for people to get a hold of you and learn more?
Through my company website. It's the company name is Velocity Capital, and the website is velocitycap.com.
Awesome. And we will link that in the show notes. Steve, thank you so much. This has been incredible. Thanks for joining us.
My pleasure. Thank you.
Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.